One of the best ways to get better at a subject is studying people that are already really good at that subject. For example, if you want to get better at your free throw shot, you may open up a video of Steph Curry or Steve Nash explaining how to shoot a free throw shot. They know what they're talking about. They're pretty good at it. They've proven it. If you want to get better at golf, you may look up a video of Tiger Woods giving instructions on golf tips. He knows what he's talking about. He has proven it. In this case, we want to get better at investing, making our money work really hard for us. And we have here 10 of the best investors in the world, and we get a specific insight into specifically what they're doing with their money, exactly what they're buying, exactly what they're selling, and exactly what they're holding, what they believe is the best investments today. These investors, again, some of the best in the world. We have Warren Buffett, the king himself. We have Dev Kantesaria with Valley Forge Management. I think that he is incredibly skilled. We have Chuck Akre, who has proven himself to outperform for a long period of time. We have Mohnish Pabrai. We have Pat Dorsey. He's the one that came up with the moat rating in Morningstar. We have Bill Gates with the Bill and Melinda Gates Foundation. His portfolio is incredibly robust. We have Bill Ackman, who's outperformed the S&P 500 for over 15 years. We have Christopher Bloomstran, a value investor. We have Nelson Peltz. He's an activist investor. And we even have Icahn, who has a history of employing aggressive tactics to make gains. So we have 10 of the best investors in the world. And what we're going to be doing is going through each of their portfolios, looking at their investing strategy, looking at what they've recently bought and recently sold, and trying to reverse engineer what they're doing, what's going through their head. So without anything further, let's go ahead and jump in. Now let's first start off with Buffett. He's had 20% annualized returns for over 40 years. He's done this by changing his investing strategy multiple times over the course of his life. Starting off with cigarette butt companies, ones that you can buy undervalued, under their book value, and then see a little bounce up in them. He transitioned over time to buying a little bit higher quality companies, following in Munger's advice. And now his portfolio is made up of a concentration into what I think are companies that are not only high quality, but I call them toll booth companies. So we have Apple. Apple is a platform company. They have 2 billion plus devices installed currently, and then they charge shelf space to companies like Google to be on their platform. They charge developers. Anytime someone does a transaction through the App Store, they take a percentage of that. So Apple is this toll booth company in so many different ways. That's the top holding of Warren Buffett. We also have more toll booth companies. American Express, a payment gateway, a payment processor. Coca-Cola Super Capital Light requires very little reinvestment. They're basically just selling a license. But we have more toll booth companies here. We have Moody's Corporation. We have VeriSign. We have Visa. We have MasterCard, and on and on and on. I look at this, and around 1 out of every 4 companies I think fits into that category. The other type of companies that Buffett buys now are typically high quality, or at least they're lower valuation. Now let's go ahead and take a look at his most recent quarter. We have him reducing his stake in Chevron. That's a little bit of a trim. He sold entirely out of Activision Blizzard, entirely out of General Motors, and entirely out of CE. I'm not sure what this one is, but these are gone. And these aren't huge sells. They're like 0.5%. So these aren't the biggest sells. He actually bought into a new company here, Liberty Media Corporation, and he also bought into Sirius. We have right here, Sirius XM Holding. Now, this again is a small buy. It's just a tiny 0.1% buy. That's still big when you're talking in terms of Berkshire. So small buys are still a lot of money when you're dealing with this much money. But this is notable. He's buying into SiriusXM, and he's also buying into Liberty Media Corporation, which I read owns a stake in XM. So that's the new company to the portfolio, SiriusXM. Let's go ahead and take a look at it using Qualtrim. This is a website that I developed as part of the Patreon membership. We have a note here that SiriusXM holdings are trading higher after Berkshire Hathaway disclosed it added a 9.68 million share stake in Q3. That makes sense. So the stock is up 6% after the Buffett bump. But let's take a look at this company. It has a lower PE ratio, but not super low. It's at an 18. The free cash flow yield looks really healthy, 5.51%. If we look at some of the financials here, the stock price has not done well this year. Buffett doesn't care about the history of the stock price. He just looks for value. So that makes sense as well. If we look at the financials, it looks like the free cash flow is going up over time, but not really. The most recent quarters, it's actually going down a bit. So the cash flow looks okay, but not great. It's not growing super fast. If we look at the earnings per share and zoom in, This is growing over time, but again, pretty slowly, 5 to 6% per year. If we look at the balance sheet of the company, I see a lot of debt here. The red lines right here, this is debt. So this is going up a lot. We have right here $8.78 billion in debt and $50 million in cash. They're leveraged roughly 4 times EBITDA. Nothing to be too concerned about, but it's still a little bit more debt than I'd like. Now, I don't know what the thought here is, but I have to be honest and give my opinion. I don't like this buy. And I don't like every buy that Berkshire does. There's some of them that I just don't like. I called Paramount Global a value trap a year ago. It's a company that I would not have bought into with the balance sheet and with the situation they had in terms of scale. Another company that I wasn't so sure on that Berkshire bought into was Ally Financial. Right during a time period where cars were peaking in price and starting to go down, with Ally Financial having that be their main source of business, lending for auto loans. And this is another one that I don't love. SiriusXM is a product and a company that's becoming consistently less relevant every single day. Less relevant every day. Think about this for a minute. SiriusXM, the entire bull case for it is that it's practically ubiquitous in cars. Whenever you go and buy a new car, it'll be pre-installed, you'll get 90 days of it for free, and you'll get addicted to the cable, internet, over-the-air radio. You'll have the nice cable channels in it, it'll have great audio, you have Howard Stern and other talk shows on it, and that locks you into the SiriusXM experience where you don't want to move out of it. So you end up being locked into this monthly subscription. But what's changed over the past 10 years? What's changed is the astronomical growth of Spotify and Apple Music and YouTube Music and Tidal and every other music company. These things are growing like a weed. Every single quarter, they add on millions and millions of users. Everybody that's millennials, Gen Z, younger, they're all using Spotify and Apple Music. They're not signing up for SiriusXM. They're not talking about SiriusXM with their friends. This just seems like something that's becoming routinely less relevant. And what I see people do now is they don't get a new car and then just listen to the radio. They get a new car and they sync their phone with it, which has Apple CarPlay. And then they use their music device with that. So I don't understand it here. I get that this has good financials. The company fundamentally looks good. But this is another one of these purchases from Berkshire that's in the bucket that I don't like, and I won't be following. I'm not going to be going into SiriusXM. His purchase in Apple, I thought was one of the best buys. In fact, it may be the best buy Buffett's ever done. But SiriusXM, not one for me. Now, one last thing I'll mention. We know right now that Buffett's actively buying a couple more companies, and he got permission from the SEC to not release those buys in this report. Since he's trying to build a stake in the company, they have agreed to delay the report of his purchases until he's actually built his stake. Fearful that he might actually push the price up if he reveals it right now. And that's absolutely true. Every company that Buffett buys goes up in price, so the SEC does allow him time to build a stake before revealing his positions. So he is actively buying something, but we don't know what it is. We're just guessing right now. Now, looking at his portfolio again, this SiriusXM buy is not going to change the portfolio that much. It's small compared to the rest of it. And overall, I still think Buffett has one of the strongest portfolios in the market. And I like that he's willing to have a large concentrated position into a high quality company and continue holding. He did not sell a single share of Apple last quarter, which shows you something. He still thinks it's good value. Next up, we have one of my personal favorite investors working today, Dev Kantesaria with Valley Forge Capital Management. He is a deeply skilled investor. He has an analytical mind. He does research that I think is second to none in terms of fundamental valuation and qualitative research on a company. He has a very concentrated portfolio where he buys companies that I like to buy, compounding machines, companies that are better than other companies. These are companies that require very little reinvestment. They're capital light. They run efficiently. They're companies that have organic growth and huge scalability. They're companies where the margins trickle up over time. No matter what seems to happen, they seem to do well. He identifies the highest quality companies by virtue of their barriers to entry, their moat, their capital efficiency, their growth, their margin expansion over time. And then he also waits patiently for optimal times to buy into these companies, waiting patiently for a dip. And then he buys into large concentrated positions. So he's very skilled with stock selection, and he also has good temperament. So I'm excited to see what Dev has been up to. What has he been doing over the past 3 months? Let's go ahead and take a look. What we have here is Zero change. Recent activity, nothing with FICO, nothing with S&P Global, nothing with MasterCard, Moody's, Intuit, Visa, Aspen Technology, and ASML. No change in any of his holdings. Now, when I first looked at this, I noticed that the Q3 report right here in Dataroma, it didn't even exist. It's not there. We only have Q2. So there's literally been no buys and sells in his portfolio. Now, I thought that this may be a mistake from Dataroma. Maybe they have erroneous data. So I went and checked on different websites. Every single website reporting his 13F filing show the same thing. He has done nothing over the past 3 months. So Dev Kantesaria decided to take a break, go on vacation, not look at his portfolio for the past 3 months. Now, that's what you might think he did. You might think this is lazy or it's easy to just do nothing. But in this case, he already has such incredible outperformance. He already has such incredible companies and positions built in these. All of these companies he's deeply in the green on. So he's in a situation where he already has an incredibly powerful company full of monopolies and toll booths and companies that have great economics, bright futures, and he's decided to let them compound, to simply sit back and do nothing. And doing nothing in many cases is the most difficult thing to do as an investor. It requires patience. It requires discipline. The urge we have as investors all the time is to do something, to take gains and sell companies or buy into new positions that just dipped. But in many cases, if you've done careful stock selection, which he has, doing nothing is the right decision. Charlie Munger has said before that the gains don't come from buying or selling, they come from waiting. And that's what he's doing here. So no changes to Dev's portfolio over the past 3 months. It looks identical. It's still this group of monopolistic toll booth companies that have incredibly powerful economics, high barriers to entry. They have very low reinvestment rate, and they pay out huge amounts of money in either dividends or buybacks. And he's concentrated into these companies to a huge extent, his top holding still being FICO. It'll be interesting to see what he does next quarter as these companies continue to race up, but for now, he's just holding. Next up, we have Chuck Akre, who manages over $11 billion plus a number of ETFs, and his quality ETF has outperformed the index over the past 10 years. Let's go ahead and take a look at what he's been up to. When we look at the biggest changes to his portfolio, the most notable one by far is him selling entirely out of Adobe. This was a large position, over 4%, which is a big position for Chuck Akre because he's pretty diversified. So a 4.34% sell, 100% of Adobe, that's pretty notable. Now, if I had to guess why he sold this company, I could come up with a couple different reasons. There's basically 2 reasons to sell a stock. One is because you think the company is overvalued or it does not present a good risk-adjusted return based on the price. And if we look at Adobe right now, the valuation doesn't look too bad, but the stock is up 76% this year. It's probably one of Chuck Akre's best performing companies in the portfolio year to date. So if he sold it around here, he made really good gains. So that could be one reason why he just wants to lock in gains, and the valuation has become less attractive this year as the stock has surged. He sells out of companies if he becomes less confident in their current fundamentals or their future. In the case of Adobe, I see this as a very wide moat company with a substantially good customer base and product distribution, but it does face competition. There's always newer photo editing programs and video editing programs. And with AI, there's a lot of competition with manipulating video and photo. And that's an ever-evolving category. And to some people, they just think it's less predictable. So Adobe's out, and other than that, his portfolio looks mostly the same. A huge position in MasterCard, a big position in Moody's. These 2 companies I think are both fantastic. He also has American Tower Corp, a REIT. We have Visa here, another great company. We have KKR, O'Reilly, Roper Technologies, Brookfield, a lot of these other very high quality companies. I still really like Chuck Akre's portfolio. I think he's one of the best. Next up, we have Mohnish Pabrai, a value investor that manages over $150 million. Mohnish Pabrai is on social media. He's on YouTube. He comes out with videos where he tells stories and narrations, and I really like his YouTube videos. I think he comes out with great content. I think he shares really good investing concepts, and I think that he's a great teacher. That's probably my favorite attribute about him. I also like that he runs charitable organizations. I think he's a very giving person. And he also has a fun relationship with Charlie Munger, so he shares stories about that. Overall, I like Mohnish Pabrai as a person. Now, as an investor and trying to get behind his investing strategy, I've really tried to understand it. I've tried to reverse engineer it. I've tried to get behind it, and I just can't. I don't understand it. It doesn't make sense to me. He went into AMR, Consol Energy, and Arch Resources. From what I understand about these companies, they're all coal companies. So he suddenly transitioned his portfolio from some of the companies that he'd talked about for years, some of these long-term compounders. He completely sold out of them, and then he went into 3 coal companies. I don't know what he saw with these companies or what he didn't see with the ones that he just previously held. Let's go ahead and take a look at the activity here to get a better picture of this. Again, he just bought into a new company. This was Arch Resources this last quarter, and then he added more to these positions. Now, what I'm talking about with the dramatic change in portfolio investments, this is the history over time. What you can see is that he just recently held Micron Technology, a company that was 80% of his portfolio. Then he also held Seritage Growth Properties. On top of that, he had BAM and Brookfield at one point, and he sold out of all of those companies, ditched all of those stories, and went into these new companies. So it's just a dramatic change, everything different about his portfolio from one quarter to the next. And this is something that I've noticed routinely with Mohnish Pabrai. For someone managing $150 million, he changes his mind very frequently on companies. He will have investing philosophies that are in depth with a company, and then he'll suddenly sell out of it for an entirely different portfolio altogether. And it seems like these jarring moves are somewhat unexpected. So I like Mohnish Pabrai as a person, but as an investor and an investing philosophy, he's not someone that I'm going to be following his trades or looking at his research in companies. There's other ones that I'd much rather follow. Next up, we have Pat Dorsey, who created the Morningstar moat rating system. So he's the moat guy, and his portfolio doesn't really resemble that. I don't think his companies have the strongest moats in the market, but overall, that's not really his goal. His stated goal, as he says, is to buy intrinsically undervalued companies. That's basically what he's doing. He manages $750 million. So let's go ahead and take a look at his portfolio and what he's been up to. I first want to look at his most recent trades here to see what he's been buying and selling. The very top one here is Roku. He sold the entire holding, 100%, which was almost a 7% position. So this is a huge holding. And Roku has had a good year, so it makes sense he's selling it right now. But he also bought into this one way too high. If we look at the 5-year chart here, Roku traded up to astronomically high valuations. It traded way down. It probably became a little bit undervalued, and it's up 125% this year. So he's using this as an opportunity to get out of this company. Next up, he trimmed his Meta position by 25%. This was 6% of his portfolio as well. And I like this because he bought into this company pretty heavily when it traded down, and now he's reducing his position when it's trading a bit higher. So a very good move from him. Now after that, we have something that a lot of PayPal investors are going to like to see. He is bullish on PayPal. He recently added a 5% weighted position in PayPal. He also is bullish on Dollar General. So we're seeing companies that have been beaten up like crazy, he's adding to them. He added to his PayPal position. He bought in new to Dollar General. Both of these companies have been beaten up like crazy. I've looked over both of these companies, PayPal and Dollar General. I've ran discounted cash flows and scenarios on PayPal. And every time I run a scenario, bearish, bullish, base case, whatever it may be, it's usually pretty positive with PayPal. Even on my bear case, when I assume that margins go down, when the company's revenue goes down, when the free cash flow is steady, it still seems like it's not a bad deal, like you're not going to lose money on it. To really see a loss here, there needs to be devastation to PayPal, a complete margin collapse with it, or complete disruption by competition. So PayPal would be my pick over Dollar General. I like this investment more than Dollar General, and I think that investors in it today will likely do pretty well. I've been on the edge of buying this one in the Story Fund. It's been one that I've just been close to buying. The reason I haven't is because I just don't know about the company's qualities long term. There's other payment companies I like a lot, Visa and MasterCard. I like Apple Pay with Apple. PayPal's one that sits in that category that I think is a bit less predictable. So I like this move from Pat Dorsey. I think buying into PayPal is a decent move. He'll probably make money on it. And I also don't mind him buying Dollar General right here. It has again been beaten up a lot, down 50% year to date. This company had been a great compounding machine for a long period of time, and then they suddenly had horrible mismanagement with their inventory. They've had consumers buying less products, and it created disaster. So a lot of the gains have been given up for the past 5 years. If they're able to recover their margins, this will be a huge recovery play. For me, this is still in that category of a bit less predictable. Pat Dorsey had a string of terrible stock picks. He was part of the fall in Meta, he was part of the fall in Roku, he was part of the fall in Wix. He had a number of top positions that were tanking. So what I see here is a nice recovery with these companies, but if I had to guess, his performance over the past 3 years has not been great. Now, one that I like to look at is the Bill and Melinda Gates Foundation. They manage $38 billion. A lot of this has been donated to them. So some of the holdings here, like Berkshire, for example, they didn't necessarily go out and buy 20% of the portfolio in Berkshire. They simply had it donated from Warren Buffett and they kept it in Berkshire. They had no reason to move it. What we see here over the past quarter is not much has changed. They've only sold 2% of the portfolio in Berkshire. So a tiny reduction in an already huge position. Nothing that I'd consider noteworthy. So overall, this portfolio looks mostly the same. Bill Gates is not taking any risks with his portfolio. It is virtually indestructible. With companies that are as blue chip as they get, they have huge distribution, and most of them are part of the overall economy. They're bought into the world economy here. So we have companies like Waste Management, Caterpillar, Deere, Coca-Cola, and Walmart. I see this portfolio as protecting their capital while growing along with the broader economy and GDP. But as of this most recent quarter, there's no big revealing insights. Next up, we have Bill Ackman, who's a very vocal investor. He used to be an activist investor, and now he takes passive stakes in companies that he considers to be high free cash flow dominant companies. Now, his investing strategy, again, has changed a little bit over time, but it's largely stayed focused on quality free cash flow companies. And he also has a performance of around 15% for the past 15 years. So he's outperformed the market by a good margin. Let's go ahead and take a look at what he's been up to. In the past quarter, what he's done is add a little bit to Google. So he already had Google as a major position. He added another 2.71% to it, and he also increased his stake slightly in Hilton, another 1.31%. He reduced Lowe's just a bit, under 1%. So not much changed there, just a bit of rebalancing. Now, when I look at Bill Ackman's portfolio, it's a good group of highly free cash flow companies. There's some I like more than others. I really like Google. That is his top position. I have a big holding in Google. I think it's a great company, so I don't blame him for owning that one. I also really like Chipotle. I think the company is underrated right now still. It's the largest wholly owned fast food restaurant chain in the world and in the US. The company has great unit economics, has incredible growth with its free cash flow. I think this is a great position. He also has Restaurant Brands International. This is one that I don't like quite as much. I don't think Burger King has the same appeal that Chipotle does to the newer demographic. I like Hilton Worldwide. This is a great company. It's very capital light, produces free cash flow, and I know a lot of investors are investing in Marriott or Hilton. Lowe's is a company that I personally don't want anything to do with right now. I don't want anything to do with companies that have a big part of the housing market. I don't want anything to do with the housing market right now. So if a company's business relies on people remodeling their home or doing big new projects, I wouldn't want to be a part of that. So for me, I would stay out of that one. I think there's better options. Howard Hughes Corp is a real estate holding. He has a special situation there, so that one's not really available to us. Then we have Canadian Pacific, a company that has very high barriers to entry, being a rail company, and they also produce significant free cash flow. The company recently did an acquisition, which I believe will increase their free cash flow capability. So that's one I'm also bullish on. I still believe with this portfolio, Bill Ackman's likely to outperform. Next up, we have Christopher Bloomstran, who manages $400 million, and I would describe him as a more traditional value investor. He takes an approach that's a bit like Buffett, where he tries to buy simply companies that have sold off and people have become overly negative. One of the largest positions he bought into, in fact, his biggest buy last quarter, was again Dollar General. So we have 2 votes from super investors on Dollar General, Pat Dorsey and Chris Bloomstran. Both of them are buying into this company heavily over the past quarter, 6.49%. When we look at this, that is a significant holding for his level of concentration. His largest holding is Berkshire Hathaway. That's around 40% of the portfolio. Then he has Dollar General right after that. So Berkshire, then Dollar General at a 10% position. I think he's making a bet that the worst is priced in with this stock, that the company will eventually recover their margins and the stock price will follow. After that, his portfolio looks mostly the same. We have some other popular companies here, and you'll notice a lot of the companies he owns fits the same type of attributes. They're companies that were at one point considered to be higher quality. We have Paramount Global, we have Disney, but these are companies that have fallen down in price, and he's betting on a recovery. So what we have here is a very conservative value-oriented portfolio with around 40% into Berkshire, and then the rest of it distributed through companies that do have decent cash flows, but many of them have sold off. I would expect this portfolio to outperform, but only by a moderate extent. Now, of course, we have to look at Nelson Peltz. He is an activist investor that controls a portfolio of over $6.5 billion. Now, he is notable for being the activist investor that's giving Disney a hard time, that's being vocally critical about Disney. And there's some people that are defensive of Disney, saying that Bob Iger's already doing everything you're wanting us to do. They're already implementing all the changes you're asking for. Bob Iger is the one that has gotten Disney into this mess in the first place. Now, this activist investor, Nelson Peltz, is wanting to put pressure on him, accountability, pointing out what's being done and what's not being done. I think that's a good thing for an executive, especially an executive that's awarded himself with tens of millions of dollars every single year. Bob Iger has become very rich from Disney, while the shareholders have not over the past 10 years. So I support Nelson Peltz in his campaign to get board seats on Disney and hold the company accountable. And what we see here in the past quarter is he's putting his money where his mouth is. He says Disney's deeply undervalued. He says that it's been incredibly mismanaged over the past couple of years, and he's wanting to change the company for the better, and he's putting a substantial amount of money behind it. So if you're an investor in Disney, this is another shareholder that's wanting to advocate for positive change that has a massive stake in the company. He added 32% last quarter, and he already had a huge position. So if we look at his current holdings, this is what it looks like. Disney's number one at 40% of the portfolio. That's incredible. $2.6 billion worth of Disney. So he's really all in on Disney. He has a huge chunk of his portfolio in this company, and he's looking for a recovery. And I think Nelson Peltz and other Disney investors are going to get a recovery. The reason why is because I've studied Netflix and I've seen the company become highly profitable as a streaming service. It is possible. Streaming can be a fantastic business. The requirement for that is scale. And Disney's one of the few companies that can reach scale eventually with their Disney Plus streaming service. Now, I think that the Disney story is more complex. There's lots of different problems and potential competitive forces with ESPN. They're competing with Netflix. They're competing in the box office. The parks are a money printer, but other portions of the business are still a little bit less they're a little bit less clear. So Disney's not my favorite bet right now. When I look for predictability and clarity, I go to Netflix. I think it has a more predictable path, but I do think that Disney investors are going to eventually see a recovery. Now, outside of Disney, the next biggest change he made was adding 2 Wendy's. WEN is the ticker symbol. He added 60% to this position. Wendy's, like Disney, is in a dip this year. It's down 13%, and he was bullish on this company earlier this year. So if it's gone down in price and he's still bullish on it, it makes sense that he's adding more to it. Now, he does have some diversification outside of Disney, but right now the dominating factor in his portfolio is Disney. If this company does not do well, his portfolio is not going to do well. If Disney has a big recovery over the next 2 years, Nelson Peltz is going to make a lot of money. So you can see why he's so advocate, so outspoken about wanting to get on the board. He really needs Disney to create value for the shareholders. Now, next up, we have Carl Icahn, which there's various opinions on him, but I believe he's a bit of a vulture capitalist. I think that he oftentimes focuses on short-term profits over long-term performance of a company. And in many cases, he goes into companies and ransacks them for immediate value extraction, which in the long term hampers the company's performance. For example, the reason that Netflix is a big company today is because Carl Icahn invested in Blockbuster. His interference with Blockbuster is considered a big reason of why the company failed to compete with Netflix. So he's responsible for Netflix inadvertently. Another instance where Carl Icahn was on the wrong side was with Herbalife. Bill Ackman accurately pointed out that Herbalife is a pyramid scheme that extracts value out of poor people, giving it to the rich people at the top of the pyramid. Carl Icahn squeezed Bill Ackman out of that position, making it so Herbalife continued on with its future. And he oftentimes makes these decisions. Now, in the case of Carl Icahn, there does seem to be some sort of cosmic justice, because if we look at his company, Icahn Enterprises, There was a short report released about the company from Hindenburg, and ever since that report, Carl Icahn's company has not recovered. It's dropped down a staggering 62%, and that has destroyed a lot of his ability to make future purchases. So when we look at it right now, the only thing that he's really done with his portfolio is buy a little bit more of Icahn Enterprises, 2.67%. Other than that, he's been selling out of positions. And when we look at his current portfolio, Icahn Enterprises is still 57%, even after dropping 60% in value this year. So Carl Icahn has taken a massive hit this year, and I think he had it coming. It was only a matter of time. Now that's all the super investor talk for now. See you in the next one.